what would you categorize as the best investment so far and the worst investment?
In 2002, many of the metal companies had become so cheap because from 1994 to 2002, the steel and iron ore had one of the worst cycles ever.
What are some factors you would consider before investing in the company?
You have to decide whether it's a cyclical company, whether it is a turnaround company, or whether it is a concept stock. If you're not capable of looking at it, you shouldn't invest in such companies.
How can one retail investor identify what kind of cycle is there right now?
Suppose past returns are very, very high. It means that the cycle is high. Past returns are very, very bad. That it means cycle is very, very low. If you went to Gurgaon, you'll find people will tell you, I have bought 3 houses under construction by paying 5% advance. You should tell them, are you sure the houses will come? No, I'll be able to sell it. I'll be able to flip it. So that was a sign that the cycle was very advanced.
Can you give an example of a time when you took a contrarian bet?
You keep doing contrarian investing on a continuing basis. What you do in 2023 will work in 26. It is not that it will work immediately, but every year you get the fruits of the contrarian thinking that you've taken some time back.
We mentioned equities, gold, silver. You're saying that all of them have given very good returns and money is there. So what is the asset class which is remaining to a retail investor? Like, where do we put money as an asset class?
I think
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
वीडियो देखने से पहले मेरी एक रिक्वेस्ट है आप सबसे. मैं YouTube एनालिटिक्स देख रहा था एंड वहाँ पर देखा कि 82.6% ऑफ माई ऑडियंस हु इज वाचिंग दिस कंटेंट हैज नॉट सब्सक्राइब टू द चैनल. अगर मैंने आपको थोड़ी सी वैल्यू प्रोवाइड की होगी एंड आपको अगर कंटेंट बहुत अच्छा लग रहा है, आई रिक्वेस्ट ऑल ऑफ यू टू प्लीज हिट द सब्सक्राइब बटन सो दैट वी कैन ब्रिंग यू द बेस्ट क्वालिटी ऑफ गेस्ट एंड गिव यू द मैक्सिमम वैल्यू पॉसिबल. थैंक यू सो मच फॉर सब्सक्राइबिंग टू आवर चैनल एंड एंजॉय दिस एंटायर एपिसोड ऑफ कॉन्वर्सेशन विद कुशल. आई हैव वॉच्ड ऑल योर पॉडकास्ट ऑन ग्रो, Zerodha, and I have watched a lot of your media interviews as well. The humility which is there, it is just shown out in those interviews as well. And since we are talking about humility, I'd like to take you back to your early childhood or maybe the first time when you started investing. So can we just take a step back and understand more about when was the first time you entered the stock markets and like what happened when you invested in that stock?
No, basically, I would have started investing in 1980s. And at that point of time, stock market, I obviously knew very little. But it's still a place where you can make money easily and lose money easily. When you make money easily, you get a thrill. And when you lose money, you get just the opposite of a thrill. So that's what you go through. And, 80s and stock market was not a common thing. So I would say there have been periods of time when you got a thrill and you got extreme unhappiness when you lost money. Both have happened at that point of time. And 80s was volatile periods. And that was something which I did along with my father. So I would say it was something like shared thrill and shared unhappiness.
So how did you enter the world of investing? Was there a trigger point for you to enter the markets or what happened exactly?
My mother passed away when I was 14. So I had a 2-member household, which was just me and my father. And surprisingly, we found stock markets to be a very good way of communication between both of us. So we found a common interest called stock market. And he knew obviously much more than me. And we found stock market to be one of the areas where we together worked on. And that became an area where I learned from him initially. So I would say that's how we got into it. And those were the periods where we used to have FERA issues, FERA dilutions, etc. And we used to have IPOs, which were like lotteries. So it was that kind of a period. And you had a period in 80s where the markets did very well, then did badly. So you had all kinds of markets at that point of time. So it was interesting.
And in your childhood, when like you were studying, if you remember, so were you always a numbers person in the school, or what kind of person you were when you were studying?
I was 100% numbers person. I was obsessed with numbers. I was obsessed with train timetables. I was obsessed with everything to do with numbers at that point of time. I enjoyed mathematics. I enjoyed everything to do with numbers. So I could possibly knew a lot of share prices by heart. And in those times, there weren't, computers. So, to know all these things by heart was obviously a very, very interesting thing, because today many of the things that you don't need to know, because everything is stored by computers, by your mobile phones, and so many things. In those days, everything was stored in your mind, and enjoying those numbers was really very, very fascinating.
Right. I can resonate to this because even when I was studying in my school, I think I always used to be a numbers person. And when you like analyze numbers and analyze the P&L, cash flow, balance sheet of the company, once you study a financials, the joy that you get in analyzing a company, that is much higher as compared to the joy of doing anything else.
Absolutely, absolutely.
Yeah. And if you talk about your best and worst investment in your entire career, so what would you categorize as the best investment so far and the worst investment?
I think I'll start with the worst. I think I spent too much of time thinking of tea plantation industry, and
Mm.
sitting in South. I've traveled to Munnar, I've traveled to Nilgiris, and I used to see these tea gardens, and I used to do this simple calculation, calculate the cost of real estate per acre of those tea gardens, and used to find them very, very cheap. And I used to think, how can you recreate a tea garden so it's like a moat? So I used to think maybe these stocks will actually do well. And I got the same feeling with some of the Assam tea companies as well. And I thought that these tea plantation companies were actually going to be something which will deliver returns. And if you go back to 1980s Madras Stock Exchange, I think 10% of the companies which are listed in Madras Stock Exchange were actually tea plantation companies. You'd be surprised to know. There were companies like Periyakaramalai, Neelamalai, okay, Peer Made, and so many tea companies were listed at that point of time in the Madras Stock Exchange and in the Calcutta Stock Exchange. I remember MacLeod, Russell, Makum, Namdang, so many other tea companies. And they were also Ferra companies, some of them which are diluted at that point of time. And I think it was a total waste. They didn't deliver returns. And I think it is the Kenyan tea companies which turned out to be much better than the Indian tea companies. There were bought out tea factories which came up, which actually destroyed value. But clearly, that was the worst, I would say. The best, what we realized over a period of time was, you could buy many of the commodity companies very cheap. You could buy, for example, in 2002, after a very, very bad period for steel, many of the steel companies, many of the metal companies had become so cheap that you can't believe that those companies had become dirt cheap, whether it was iron ore companies or steel companies. Because from 1994 to 2002, those 8-year period, the steel and iron ore had one of the worst cycles ever. You could have never believed that iron ore would go down to that price. And 2002 to 2007, thanks to China, was exactly the opposite. And some of them turn out to be 50 baggers in that period from 2002 to 2007. So I would say many of the metal companies, and after that, it has stuck that if you see any commodity stock in doldrums, it's something which fascinates me, because I've seen that commodities, you sometimes don't need to look at the management. Those commodities the worst management can turn out to be one of the best companies later when the cycle turns. So I've seen it across commodities, whether it is metals, whether it is chemicals. Across, you've seen situations where the worst company becomes very, very good. And that's what I would call the best company, because you don't need to then look at the company, you don't need to meet the management. The management itself didn't know that things will improve from 2002 to 2007. If they had known it, they themselves would have bought much more of their stock. They didn't know that. They used to think that their sector is gone. But from 2002 to 2007, the sector did so well.
So, what went wrong with the tea plantation industry, and why do you think the companies which were there, the companies that you named, were not able to deliver the returns?
I think some of them had bad corporate
Mm.
governance. I think the African tea companies turned out to be more efficient. I think the African cost of manufacture of tea was turned out to be much better. So I think it's like, the moat was not there. We used to like the Assam companies, their tea gardens look good. Maybe the Munnar and the Nilgiri tea gardens look good, but the Kenyan tea gardens were much more efficient. And clearly, I didn't go to Kenya. I only saw these tea gardens and they were looking good. They didn't make money.
So, do you think that it was like one of the mistakes where you invested in those companies too early without doing a lot of homework or research?
No, I wouldn't even say that I misjudged the moat. It is like, if you look at what happened to Warren Buffett in print media, for a long period of time, print media was considered to be one of the best moats. But then subsequently, internet destroyed the moat. So I would say it's not possible for all of us to know what is the moat in a sector. Print media was an unassailable moat. People thought that print media moat will never disappear, but over a period of time, the moat just disappeared. So like that, the judgment was wrong that African tea could not have done well, but later we realized that African tea was possibly much more efficient than Indian tea companies. It is just like what happened in US. Many of the railroads came and they got destroyed by the highway system that got created. What is called as there's a famous new article written by Theodore Levitt called Marketing Myopia, that you have to know what is the need being satisfied, whether it is oral, for example, mobiles destroyed landline phones. Scooters were never were turned out to be replaced by mobikes in India, because transportation started happen through mobikes in India. So I would say marketing myopia is something, one of the most interesting pieces written, and which people have to be aware of. What is the need being satisfied? Suppose you have the investment need, you can't say that Madras Stock Exchange will satisfy it or Calcutta Stock Exchange will satisfy it. You have to remember that you can always get disrupted.
Hmm. And when you said about the best investments, that even if the management would have been not the best, but the companies would still perform the best. So when you are evaluating any investment opportunity, can we break it down with some examples of what are some factors you would consider on the quantitative side as well as on the qualitative side before investing in the company?
See, clearly the quantitative side, you have to decide whether, I think it's very clear, you have to decide whether it's a cyclical company, whether it's a steady company, whether it is a turnaround company, whether it's an asset backed company, or whether it is a concept stock. So if you are wanting to buy a concept stock, let's assume you were trying to buy Google 20 years back. You should know how to look at a concept stock like Google or Facebook 20 years back. If you're not capable of looking at it, you shouldn't invest in such companies. So if you're buying a steady company, you should know you're buying a steady company. If you're buying a steady company, you should know what valuation you're playing. If you're investing in a cyclical stock, you should know where you are in the cycle. Are you buying it at the top of the cycle, bottom of the cycle? If you're buying it at the bottom of the cycle, you are in very good shape. If you're buying at the top of the cycle, you're making a mistake. If you're buying a turnaround, you should know how to evaluate the turnaround. Sometimes turnarounds never happen. The turnaround takes 30 years, or it may never happen. The company may just go bankrupt. So you have to know what kind of a company you're investing. Suppose you're buying an asset-backed company. You have to know whether that asset-backed company will ever sell the assets or never sell the assets. So you have to know what kind of a company you're investing in. And based on the kind of company you're investing in, you have to follow a right strategy.
So can we break it down into these companies that you just mentioned, 4 or 5 types, and let's take an example. So for example, if it's an asset backed company or if it's like a concept company, so is there a framework that you have before investing in these companies? If we can just break it down.
Absolutely. I think a concept company, only one set of investors should invest in. So suppose I'm a technology person and I understand that technology, and then I'm doing concept investing in that technology. Let's suppose I know e-commerce and I am looking at an e-commerce concept stock, then it's okay. The problem in India is suddenly you may not know anything about e-commerce, and then you start buying an e-commerce concept stock, then the chance of losing money is very, very high. So when you end up, suppose you are trying to buy a solar company, which is a concept stock. If you don't know anything about solar and you're trying to buy a concept stock in solar, you run a lot of risk by buying that solar stock. Suppose you're buying a drug discovery company and it's a drug discovery company. Again, you're buying a concept stock and you know nothing about drug discovery. Again, in all these things, actually, you're buying blind. The chance of you losing money is very, very high if you don't have any capability to look at stocks in that area. So I would say concept stocks are best avoided by most investors. But if you're a specialist in that area and then you're buying a concept stock in that area, that means you have some sense in that area. You have the right, some chance of right to win. So I don't think people realize that. They want to buy concept stock outside their what Warren Buffett calls circle of competence. You have to have a circle of competence to invest in concept stocks. But if you're talking about asset-backed company, let's say you're buying an asset-backed company, you know what is the asset it is holding, and then you have to assess whether that asset they're going to sell, whether the promoter is going to sell that asset. Suppose that asset is, let's say, a piece of land that the company owns. You have to judge whether that company is going to sell that asset, which is that piece of land. How are they going to sell that? Whether they're going to do it, when they're going to do it. Do you think the management is interested in selling that piece of land? These are the questions that company has to do. And are you willing to go to the annual general meeting and ask that question? Are you willing to write to the management and ask that question? Because in asset-backed companies, sometimes the return will come only when the asset is sold. Otherwise, you may not get the return. So that's the kind of framework that you have to think about.
And what about the management quality? So if we want to evaluate the management quality, so is there any framework there? Like you will ask certain questions, you would want these things from the management before investing.
See, management quality is best seen from the past. So that's why if you're buying an IPO company of a new management, then it's a big problem because you don't know the past of that company. But otherwise, the past tells you whether the management quality are good or bad. It is very, very rare that you have, for example, there was a liquor magnate. The father built the entire empire. The son did not succeed with it. But the fact is, in that case, actually, the father was known as a legend. But otherwise, I would say it is the past which determines what happens. So you look at the past. The past determines whether it's a good management or a bad management. So unless, sometimes the next generation can be bad. Sometimes, you have a CEO change. For example, in professional companies, you have CEO change. Sometimes the next CEO can be much better than the previous CEO. Sometimes the next CEO can be much worse than the previous CEO. So I would say management quality is always dependent on by looking at the past. Sometimes when CEO changes, we have to look at the new CEO. But how do you judge the new CEO is a very difficult art. You can go look at the past performance of that CEO in earlier jobs. So if it was a department that person was running, look at whether the department that person was running did well or not. If that CEO was a CEO in earlier jobs, then look at whether that CEO actually performed in the earlier jobs. If that performance was good in the earlier jobs, I assume that that person will do well in the new jobs. This is the kind of framework that you can use, frankly. But the biggest mistake people do, that's why IPO companies are inherently risky, because you don't know whether the management is good or bad. You will come to know after one bull and bear market whether that person, whether that management is good or bad. Because if it is an old group, let's assume it's 100-year-old group and the company is coming up with an IPO in a new company, then it's okay. But then you know the group. You know how they behave in their old companies. So you have to assume that they'll behave in the same way in this company. So that is very safe. But otherwise, you have to wait for one bull and bear market to know how they will behave in that bear market. And that was clearly seen in the 2008 cycle. In the 2008 cycle, many of the companies which had raised money in 2007 behaved very badly. And we suffered in some of the new companies.
And when you talk about cycles, you also mentioned in one of your previous answers that not investing at the top of the cycle, investing at the bottom of the cycle. How can one retail investor who's watching this video identify what kind of cycle is there right now? Are there some metrics or trends that you look for before identifying
But
cycles?
some of those trends are easy, but that may make you wonder what to do today. Suppose past returns are very, very high, then it means that the cycle is high. Past returns are very, very bad, that it means cycle is very, very low. And if you compare past returns, that's a very, very good indicator. So if you looked at 2002 metals, you had 8 years of no return. So it's easier to talk about some other country. In 2012, we had launched a US fund uh, in ICICI Prudential. That point of time, do you know that 12-year returns on US NASDAQ was zero?
Oh,
And when we launched it, people said, why are you launching US? US is not the country which can deliver returns. Today, if I had to tell you that the 12-year returns is zero, people will possibly be surprised to know that in 2012, 12-year returns in US was zero.
my.
So what happens is the best way to assess the cycle is by looking at 12-year long-term returns at that point of time. Valuation is there, but then valuation is sometimes difficult to decipher. So you go to real estate in 2013. We used to tell people real estate has done so well for the last 10 years. Equity has done so badly for the last 5 years. Why don't you look at equity? After all, real estate has done consecutively well for 10 years. So the real estate cycle is much, much more advanced. The equity cycle is much better in 2013. It was very difficult to get money in 2013. Although equity was much cheaper, and real estate was much costlier because real estate had continuously gone up from 2003 to 2013. So I think the easiest way to determine a cycle for a person who doesn't know high finance is past returns. So today, if you look today at let's say a country like US, clearly past returns are very, very high. So you have to be careful. That's what it tells you. You look at dollar. Dollar has done so well against, let's say, Japanese yen. So you have to be careful. It means that the US cycle is much higher than what it is in 2025. So past returns is one of the best ways to judge. The second is how people behave. So in 2013, you will find that everyone around you is investing in houses, and no one will be talking about equity market. And in when everyone around you today, for example, in 2025, whenever we go for a meeting, one of the questions people ask, what should we do in gold? Should we not invest in gold? Simple. It's the best performing asset class on 1 year, 3 year, 5 year, 10 year, 15 year. So obviously people will ask you that question. So which means, what is the asset class you have to be careful on for the long term? It is gold. People ask, does it mean next 6 months will be bad for gold? Answer is no. But clearly, gold is one of the asset classes which has done the best on all time periods, which means that you have to actually think about it. If you take the next decade, this may not be the best time to invest in gold, based on the simple framework that everyone asks you in every meeting, what do you do with gold at this point of time? And that is the best indicator of what a sentiment is. How many people ask you a question when you go for a meeting? Wherever we go, that's a question people ask at this point of time. That's a very, very good indicator. So what people do around you, what is the past return on that asset class? What kind of question people ask when you go for a meeting? And who seems to have made maximum money, taking maximum risk? That is also an indicator of the asset class which seems to be dangerous.
Can you elaborate on this?
See, in 2013, if you went to Gurgaon or Noida, you'll find people will tell you, I have bought 3 houses under construction by paying 5% advance. I should tell them, are you sure the houses will come? No. I'll be able to sell it. I'll be able to flip it. So that was a sign that the cycle was very advanced. So at the top of the cycle, people will take leverage when they should not be taking leverage. and leverage at the top. If you go back to 2007-8, you would have heard of the subprime mortgages. So at the top of the cycle, people will take leverage in a stupid manner. That is a sign of a top of a cycle. And at the bottom of the cycle, people say loans are very risky. I will not take a loan at any cost. And at that point of time, interest rates will be very, very low. So go to 2003, you will be surprised to note that dividend yield on most stocks on many stocks were higher than deposit rates. It has never happened after that. But 2002-3, that was the situation.
Hmm. And as far as this analysis is concerned, so at present, what kind of market cycle do you see in the Indian economy then?
It's a very tough cycle. It's a cycle where there is no asset class which is cheap at this point of time in India. Indian real estate is not cheap. Gold is not cheap. Equities is not cheap. So it's an asset class where it is tough to make big money from here. So it's a time actually that you have to be careful. It's not an asset. 2025 is not an easy year. So my guru Howard Marks says you have to ask yourself every year, is this a year to make a lot of money, or is this a year to avoid loss of money? This is a year to avoid loss of money. That doesn't mean that India is bad macroeconomically or something like that. But this year is not a year where you see fear.
Hmm. And if we just talk about the gold and silver, which you mentioned about the asset classes. So silver in, I think, October, November 2022, you had passed out a statement about silver, and silver, I think, had performed really well in that year as well. As of now, what's your lookout or view on these asset classes? Gold, I think you mentioned that it, like, in the next 6 months, maybe it can do well. It is at an all-time high. So what about gold and silver? Like, what's your view on these asset classes?
No, silver is better than gold because it has underperformed gold. But silver also is not as attractive as it was in 2022. 2022, it was really attractive. It's not as attractive as 2022. Having said that, today the asset class which people fear, which may go down, is dollar. So for that reason, people invest in everything other than dollar, which includes gold, which includes silver, etc. So no one knows what will happen to silver, but it's not a super attractive asset class like 2022.
Got it. And if we just talk about the contrarian thinking approach, which you are always like implementing in your experience as well, like you're known for contrarian thinking and taking contrarian bets. Can you give an example of a time when you took a contrarian bet, it went right, and an example of a time when you took a contrarian bet and it went wrong? The reason of asking this is because we also want to understand how to develop that contrarian thinking, which is very difficult for a person to develop.
It's pretty tough. I think the toughest period was 2018, 19, 20. So we thought PSUs were cheap. We thought metals was cheap. We thought telecom was cheap. So 2018, we thought it was cheap. 2018, second half, we thought it was cheap. 2019, we thought it was cheap. 2020, COVID came. All those things came down even further. So people started asking, what is this PSU, PSU, PSU? You keep saying metals, metals, metals. You keep saying telecom, telecom, telecom. You keep saying. It was so tough. So till 2020 October, I remember in 2020 October, it became so difficult to hold that position because all the way from 2018 to 2020 October, it didn't work. But 2020 October, suddenly it started working. And after that, it became a breeze. But just imagine, for 3 successive years, from 2018 to 2020, it was a very, very tough time. And I heard that I was not a fund manager, but late 90s was the toughest period for contrarian investors in the world, that almost half the contrarian investors lost their job globally, because that technology boom that happened in late 90s in US, it actually took most of the contrarian people's jobs. That's what I hear. And that is but I was not a fund manager then. It was one of the toughest periods for contrarian. Otherwise, by and large, what happens is the model which works is you keep doing contrarian investing on a continuing basis. So what you do in 2025 will work in 2028. What you do in 2024 will work in 27. What you do in 2023 will work in 26. So what happens is, it is not that it will work immediately, but every year you get the fruits of the contrarian thinking that you've taken some time back.
Hmm.
So that is what helps you to survive or make money or whatever you may call it. So what happens is, there may be a year where you get all of it in 1 year. Then you start telling people everything got bunched up. Now be patient. But otherwise, what happens? It has to be previous year's contrarian thinking which has to work. And that has happened. If you look at years like 2023 and all that, almost everything that we had thought of in 2018 to 20 worked in 2023. So you got extra returns. That extra returns was actually bunched up returns which we didn't get in 2018 to 20. That happens very frequently. But otherwise, we believe that you have to get the returns this year for an earlier year's contrarian investment. You can't expect to get this year's contrarian investment return immediately. That's never the goal, and never do we attempt it. But then it's not possible. Then everyone will do it. Why everyone doesn't do contrarian thinking is that it is not, people don't want to wait. And for example, if Warren Buffett is sitting on $300 billion of treasury money, it is because he knows he has to wait to invest. If you're not willing to wait, it's a problem. So how we solve the problem is by earlier year's investment working, not by this year's investment working this year. If this year's investment is going to work immediately, then everyone will do that.
But if someone wants to develop this entire framework of contrarian thinking, which is very tough, which you also acknowledged, is there anything which can help them in order to become a contrarian investor? Or I'm just trying to understand, if I want to become a contrarian investor, what are some things I should do or I should keep in
It
mind?
should work for you once, it should work for you second time, it should work for you third time. Then after that, it gets ingrained in you. Then it is like that morning cup of coffee that you cannot get away with. You will do it naturally and you will not have the stress others have it. So I believe it has to work that first, second, third time. Then you will not worry about it. But that first, second, third time is tough. That is why a contrarian thinker remains a contrarian thinker. But because it is like, the first time you drink coffee, you might have that bitterness of caffeine. But at the first time you drink it, you think, why do you like it? But after some time, you can't get away without that morning cup of coffee. It's like that.
Yeah. So at present, if we talk about, so I'll ask you a trick question. So the Peter Thiel question, which he asks to everyone, what is one truth that very few people agree with you on at present? Which is like a contrarian thinking
The
question.
truth today is, if I tell anyone in India that at some point of time equity markets will fall, and they will have to be prepared for it at that point of time, and they cannot put all their money only in equities, and that will cause them trouble, people laugh at me. They say, how can equity market fall? Equity market will never fall. That is the truth that people don't want to hear from me. I tell them, having seen 90s, having seen that period, I agree India macro is good, but still at some point of time, equity market can fall. And when that falls, they can't say, why did it fall? Something no one is prepared for. And everyone loves to give targets like 1 lakh Sensex, 2 lakh Sensex, etc. Those kind of targets unnecessarily create this belief that equity market will only go up all the time. That is not the case. And this is the problem at this point of time. That the downside risk in equity market has been completely forgotten. And we as custodians of public money have the biggest challenge at this point of time in the marketplace, because from 2013 to 2025, we have not been able to demonstrate that there can be a negative market. So it's very good to have positive market, but people don't know the risks of equity.
Every year-on-year basis, Sensex and Nifty have always given positive returns, except like 1 or 2 years.
Yeah, it has fallen for brief periods of time. 2020, it fell for a brief period of time, but it recovered. So now people say market falls, immediately it recovers. Why are you worried about it?
And for anyone who wants to diversify and stay diversified in terms of investing in different asset classes, a lot of people who are watching this would be like 23, 24-year-old who are watching this. So what is like an ideal asset allocation according to you that they should have percentage wise these many percentage in these many asset classes? Is there some framework?
There's no fixed framework, but definitely add debt to it, which is today a very, very contrarian asset class at this point of time. So I would certainly say add debt to it. If you know a way to invest in equity outside India, which has done very badly, that would be something you add to it. These are things that you should add. I mean, clearly till 2023, 24, we used to put money in gold. But today, when gold has done so well, I find it so difficult to tell that. So I would tell people, put money in REIT, put money in InvITs, because I don't think REIT InvIT has done that well compared to equities. So that is another asset class which we tell people to do. So these are things which we tell people to do at this point of time. So if you know what is most unpopular at this point of time, if you can tell me, I'll tell you why don't we consider that. If you can tell me what it is, I'm very interested in hearing from you. What people don't like to do today?
I think people wouldn't like to invest in real estate today, especially I'm talking about my generation, okay? As far as my conversations are concerned. So real estate is something that they don't like to invest. Apart from that, I think bonds, so debt actually, people like of my age, they don't invest because it's like 8%, 9%, 10%
That's why I
returns.
said debt. Real estate, there are parts of India where real estate is still very costly. So I don't know whether real estate is a contrarian asset class or where you should invest, because if you look at parts of India, real estate is very, very costly even today. So that's why I don't consider it a contrarian asset class.
Yeah. And even like corporate bonds, if they are there. So like corporate bonds or fixed deposits, that is something which people of my age would never do.
Yeah.
I mean, I also would never put it into fixed deposit because it wouldn't even beat the inflation. So yeah, these are some unpopular opinions as of now. People of my age, they are very inclined towards equities as an asset class, like stock markets. Like since COVID, actually, the retail investor boom has been like on the rise. And all my conversations with my friends have been related to stock markets. Some of them have been related to equity mutual funds, specifically like after the COVID thing. A lot of people have started SIPs and all. My friends who are not even from finance background, they have started doing an SIP and they have started doing that. So that is little popular in my age group.
Yeah.
So I don't know, I mean, if this is true or not, but yeah, this is something which is popular. So yeah, this is about the asset class. And then if you talk about the allocation from a percentage wise to mutual funds as an asset class, equity mutual funds, like what proportion of a person's net worth who's like young should go into equity mutual funds as an asset class?
See,
To you?
what we have been trying to do is put money more in hybrid mutual funds rather than equity mutual funds. If you want to put large, nothing wrong with equity mutual funds. But I'm saying if you want to put 100% of your net worth also, you can put it in hybrid mutual funds. So that is what we tell people, because once you put it in hybrid mutual funds, you're practicing asset allocation. So which means it is much, much more safer, because you're not putting 100% of your assets in equity. So if you put money in equity, you have to look at your risk factor. You have to think of what you have to cover up for, what you need, what are your responsibilities, etc., etc. Whereas you put money in hybrid mutual funds, you have money in all the asset classes. You have money in equity, debt, REIT, InvIT, everything. So that's why we like that more than investing. But if you want, that is how we've been telling people, because we have been telling people over the last 1.5, 2 years, practice asset allocation, because equities is no longer a cheap asset class. But and that is what we've been telling continuously to most people.
And when you say that, like even 100% of the net worth can be gone into a hybrid mutual funds, etc., and people can also invest in mutual funds, are there any factors, frameworks which you recommend anyone who's watching this? What are some things they should analyze before investing in any mutual fund?
See, one thing people always think is that past performance is equal to future performance. That is not the case. And just because past performance is stupendous doesn't mean future performance is going to be stupendous. That is not the case. So this is the challenge, of investing, actually, that past and future, and that's what the regulator also tells us to put in advertisements. But the fact is that, people don't understand that, past is not equal to future. Sometimes the past can be done on a small asset base, which was easier to manage, and therefore you could do a lot of things. But today the asset base is higher, and therefore you can only do a few things. So I would say that, people looking at the past returns and taking decisions only on the basis of past returns will definitely end up making mistakes. That is true of asset classes also. That's how in 2013 people chose real estate over equities. People did not invest in US in 2012 because past returns. I would say that the best time to invest in anything is very, very low past returns. And the worst time to invest is very, very, very high past returns. This is something which I try to tell people. I know it's a contrarian statement, but I can tell you something which is very, very important from a mutual fund point of view is this, and it has worked. And it's so tough to tell people. I used to struggle in 2000 and in 2007 8 in infrastructure fund to tell people that infrastructure funds did extremely well in 2007 8, but past returns were too good. This past returns and future returns are not linked to each other. Past and future are not same, and that is something which people find it so difficult to understand in investing. They always think it is linked. It's not linked.
So you said that people should not look at the past returns when investing in any mutual fund because that is not a guarantee of future returns. But if you talk about what to look in a mutual fund, then what would those things be?
See, I'm saying most people, there are a lot of people. See, I believe that there are a lot of people who would want to give the right advice at the right time to the right people. So use them. That is what I would say, because if you use past returns, it's not going to work.
Yeah.
So it is better to use the right person's advice at the right time rather than using past returns, because past returns will it'll mean revert. The best past returns will lead to bad future returns very often. And that is why I would say this is the model that I would like to think about.
And when you say listen to a person's advice, so I think you would mostly mean a lot of like mentors or financial planners.
It could be good
which would
financial planners, those kind of people, good registered investment advisors. All these people, I mean, good mutual fund distributors as per whatever norms that they have.
Yeah.
Okay, these are the things that are useful, because otherwise, I would say you will end up using past returns. It doesn't work.
Yeah.
Everything mean reverts.
And when we talk about people or like some of the mentors that even you have looked up to when it comes to investing, you mentioned one name, which is Howard Marks. What are like some top 2-3 things that you have learned from Howard Marks and you apply in your day-to-day life?
I think I did not know the word called cycle. I did not know the word called cycle till he taught me. But after that, I learned that cycle, how to explain cycle to people. That I learned from Howard Marks. See, simple things, that, everyone believes in certainty in investing. He said there's nothing called certainty in investing. I mean, the day I start telling you things which look certain, then I'm actually not telling you anything proper. There's nothing called certainty. Everything is a bit ambiguous and probabilistic. So, like, simple things that you have to ask yourself. Are you trying to make money? Are you trying to save money? If every year I ask myself this question, every 6 months I ask myself this question, every stock that I buy in my portfolio, I ask myself this question, it helps different. So, for example, when I'm a fund manager, I ask myself this question: am I running this fund to make 20%? Am I running this fund to make 10%? This is a question. All these kind of thinking I've learned out of reading all his memos over a period of time. Because many of us think, investing is like, arithmetic. It is far away from arithmetic. Investing is something where you will keep making mistakes. You have to make the least mistake compared to others. The day you make least mistakes and do lot of some things correctly, you have made money. The day you think you're going to make no mistake, you're gone. That's what he taught me.
Very interesting. And any other investors you look up to?
Many. If you ask me, we learned initially from the great Warren Buffett and from Charlie Munger, because those were the people who actually wrote in the 90s. They were the people whom we learned from. So there is a person called Michael Mauboussin who said that at all points of time, we do post-mortem after making a mistake. He said something called pre-mortem. He said, think today, what would you do if this happened? So at various points of time, we think that if this were to happen, if suppose there were to be, this is what is going to happen in the election, this is what is going to happen in the budget, how will I react? So we at ICICI think how we'll react. So it becomes a pre-mortem. In pre-mortem, what happens? No one throws stones at anyone else. So we think very balanced way. So you take much better decisions. So instead of doing post-mortem, we do a lot of pre-mortem. Pre-mortem doesn't mean you don't make mistakes, but you're doing decisions, taking decisions in a very, very calm, settled environment. This is something I learned from Michael Mauboussin. Someone totally outside investing, I learned from Dr. Atul Gawande that to avoid mistakes, you write a checklist and you follow a checklist. That checklist should be based on all the things which helped you to make money. You create a checklist so far. All the things which made you to lose money till today, create a checklist. Then keep revising that checklist. That checklist can't be more than 10 points. Keep this one set which helped you to make money till today, one set which helped you to lose money. Both these you keep. It can't be more than 10 points. So whenever you're taking an investment decision, see both. Is it part of both? Is it that I listened to Naren in this TV, due to that I lost money? Then a part of that, then say, no, I won't listen to Naren. If it is, so see which checklist works. And those checklists, no, I always follow Naren, I make money, see this checklist. So keep both the checklists ready. And every investment decision, you see one of these. But the checklist can't be more than 10 points. If one more point comes, remove one of the points. Because any checklist which is too long won't work. Apparently, all landings of all aeroplanes happen through checklists. That's why they don't have any accidents. So this is something I learned from Dr. Atul Gawande. So I believe, like this, investing, people read newer and newer theories. Actually, you don't need to read newer and newer theories. You have to follow simple theories consistently. And the point is, people keep on reading newer theories. Those newer theories are not needed. Because investing is simple. If you look at it, Warren Buffett, for this 95 years, did not change his theories. And he stuck to his theory. Particularly when you're managing your money, you're not answerable to other people. People like me who are managing public money are answerable to more people. So we have to at least understand and be aware that we are managing other people's money. So we have to answer more people. When you're answering your own only to you, I mean, Warren Buffett has shown you don't need to have too many theories. Just follow simple principles.
What are some things you have learned from Warren Buffett? From his memos or
a lot of things. But actually investing is simple. But it is very difficult to implement simple things at various points of time, because very often we want to make money too quickly. That is not possible.
Yeah.
The money he made was because he lived for 94 years without jealousy or envy or something like that. He just used the power of compounding. And, people don't realize, it seems most of the money he made was after the age of 55. And the fact was, he was not bothered about what others did. He did what he was doing. He didn't bother. He didn't say, I'm going to start a mutual fund. I'm going to start this. He did what he wanted to do. I mean, he did what he was wanting to do. You also can do what you want to do, but actually follow simple principles. What he has written, there's a very nice article of Safal Niveshak. I think he has put it up in his website. I think he has written the last summary. That summary you read, if you can read it 10 times in a year, that's enough.
That summary is about Warren
Warren
Buffett
Buffett.
learnings. Has there been a client story in your entire journey or experience where one client who came to you and through SIPs or maybe through investing in mutual funds, their entire life turned around or they became financially independent?
No, actually, it happens to many people, to be honest with you. And many people tell us what all they could do over a 20-year journey. I mean, I've spent 20 years in this company, and ICICI Prudential has managed so much of money that, there are so many stories actually. And that is the beauty of working for ICICI Prudential Mutual Fund, that we touch so many people all over India, whether it is from Jammu and Kashmir to Tamil Nadu, or from, if you look at it from Assam to Gujarat, we touch so many people. But the challenge is that we have had 12 years of up market. So the bigger challenge is, as I told you, is when the market has a fall, have we managed that money properly in that period? The last 12 years was a breeze. I would say that's not the period I'm worried about. I'm worried about, have we handled the public money more carefully and handled it by being more defensive on the way down, by actually getting more and more people into hybrid funds and those kind of things. That is a challenge at this point of time.
Yeah, even I wonder sometimes. I mean, like, since you manage such a huge money, 8.5 lakh crores, etc. So, I mean, when you sleep and if the markets go down, you'll always be under pressure that there's so much capital that is being managed. Like, doesn't it bother you when you're sleeping at night?
It does bother us all the time, but at the end of the day, we have to ask ourselves every day what ICICI Group, Mr. Sandeep Bakshi, Nemesh, everybody tells me is that you should take all the decisions in the right way. Beyond that, you can't control the markets. If you could control everything, it is a big challenge. So I would say that is the principles under which we manage all the money.
Hmm. And what are like some themes or sectors that you are bullish upon as far as the Indian economy is concerned right now?
See, that way you look at it for the next 20, 30 years, both Indian consumption and Indian infrastructure and Indian manufacturing, everything should do well. The challenge is that, is it already is the valuations priced in or not, is the debate that we have to have. It is not that India is not a growth story. India is a growth story. What is priced in? What is not priced in? Is there a difference between what is priced in and what is not priced in? Is there a scope to make money out of what is not priced in? Those are the questions which get us into a lot of thinking.
So, like, if we can answer those questions also one by one. So, what do you think, like, what is priced in which of the sectors right now?
No, I think, see, when so much of money comes into the market and when India is macroeconomically in the best position compared to most other countries in the world, there is almost, see, India's growth is kind of priced in. Now, what is not priced in is 1 year later, maybe there is scope for compounding. So that may not be priced in. But if you're asking me, is the growth priced in? Yes, but there is a compounding of India, no, as years go by. That may not be priced in. So that is where it is. But India is not a cheap market. India is the costliest market in the world today, along with some of the US stocks. So India's growth is priced in, but compounding may not be priced in. The fact that India could have 30 years of growth. So 1 year later, that 1 year's growth may be priced in already. So when you go 1 year later, that 31st year of growth may not be priced in. So that kind of compounding may not be priced in at this point. Otherwise, a lot of it is priced in. So I would say pre-2020, we had a market where some parts of the market just didn't go up. So we had areas where we could say there was deep value and we could buy those value. Those kind of markets we don't see right now. I mean, 6-9 months back, we used to think banking was much cheaper than the rest of the market. No, banking did well. So I would say those kind of situations are there today, that today there is so much money in the stock market that any area of undervaluation gets corrected very quickly.
So then if we talk about asset classes only, so equities, we mentioned equities, gold, silver, you're saying that all of them have given very good returns and money is there. So then what is the asset class which is remaining to a retail investor? Like where do we put money as an asset class?
See, what we tell people is you do asset allocation and aim for moderate returns.
And what do you mean by moderate returns?
See, could anyone have predicted what kind of tariff war you would have got into? Could anyone predict what kind of wars we have had in the last 3 years? There's so many imponderables. I think it is very unfair for people like us to give a assured feeling that this is the kind of return you will get from an equity kind of product. It's not correct. That's why it's not fair on our part to come and give a number. So I would say markets are not cheap enough to give a high number. If markets weren't a fear, we can give a number just to get confidence. We can give a number. That's not the situation in the market today.
And how has your relationship with money changed over time, over the last 3 decades of investing? Since you manage 8.5 lakh crores right now from ICICI Prudential, so how has your personal relationship with money changed?
Changed a lot. Actually, it's become unemotional. You have to be unemotional about money. That's what Howard Marks says. When you're managing so much public money, unless you are unemotional, you won't be able to take big decisions on public money. You have to be unemotional. The ability to take big decisions has to be unemotional. And that is the only way in which you can take rational, big decisions on public money. So I would say that is the answer that I've learned from Howard Marks in one of his things. So that's why, for example, in the month of March in 2020, we deployed more than 10,000 crores in equity. Looking back, I mean, what gave us the confidence to invest 10,000 crores in equity in the month of March 2020? It was being unemotional. Because if we were emotional in that month, it would have been very difficult because people said that the end of the world is near. So I would say we were unemotional, so we could deploy 10,000 crores of money.
Yeah, that's a very, very good example. But again, a follow-up question here would be then, how do we become unemotional with money? Like, what should we do so that we also become unemotional?
I think, no, it is like, what Gita says, no, you can't be too attached to it. If you are going to daily be attached to what will happen to the market, you can't take that decision. So, in my opinion, it has to be more like, what Bhagavad Gita says, you have to do your karma. And then what you get out of it, you can't be very much bothered about it. You have to do what you have to do. You have to follow your process. You have to do your karma. The output is not in your hand. That is the process which helps you to actually take these decisions. If we are daily thought about what is happening in the world, can I put the money? And I don't want to take recent experiences, but I'm just saying that it is tough to take these decisions. It's much better when you say, I'm doing my karma, I'm following my process, this is what I have to do today.
Got it. And in terms of the best 3 books which you would recommend anyone to, let's say, learn investing, what would those be?
See, there's a book called More Than You Know, written by Michael Mauboussin. There's a book written by Dr. Atul Gawande on checklists. Then there is a book written by Howard Marks on uh, uh, ra- uh, on cycles. I would say these 3. And there's a nice book written by Gautam Baid on lot of. It's a comprehensive book on investing. And I really like even Devina Mehra's recent book. All these are, I would say, books which I recommend to people.
Money myths and
Yeah,
mantras.
money
Yeah,
myths.
right. And in terms of your learning sources as of now, like any specific newsletters, any specific Twitter handles you follow regularly to stay updated?
See, we do a lot of reading. You read Financial Times, you read Wall Street Journal, then you read Indian newspapers, then we have access to global research from many places. So between all that, there is no shortage of reading. There's only so much time. So between all this, we have to decide what to read, what not to read, and how much time we have. We manage to decide what to read, what not to read. We have to do it. There's no shortage of reading these days. The challenge today is deciding how to manage your time in such a way that there are things that you have to tell some of your colleagues to read, and ask them to read it for you and give the gist of what is to be read. And of course, you can possibly use AI or something like that soon. We started to think of it. We are creating software for that also.
Oh, is it?
Yeah.
So how do you use AI in your
AI
day-to-day
can
life?
summarize these things and give you just a summary of, even today now, summarizing YouTubes can also be summarized.
So I use this tool called Notebook LM of Google, and for summarizing any YouTube videos or getting like crisp insights from that video, I usually like have
Yeah.
interactions with Notebook LM, and it's like a beautiful tool.
Yeah.
Almost on a regular basis, I'll be like inserting 4 or 5 YouTube video links and then asking, okay, what are some numbers, what are some insights that they have spoken about, what are some follow-up questions that I can ask from this interview in the next podcast. So it's like very, very helpful.
Yeah, that's true.
And it also does something where, let's say if I insert that video link and then if I want to convert that into a podcast, so that will get summarized into a 10 minutes podcast by AI only, and I can also listen to it
Wow.
whenever I want.
Wow.
So I think AI is like taking just the taking the charge right now. And any other AI tools that you also use in your regular
No,
day-to-day life?
we have started work on it.
Hmm.
I think that's what my colleague has.
Got it.
I'm not good at it, so luckily one of my colleagues has taken the trouble of moving forward on it.
Got it. And in your entire life so far, in your entire journey, is there some sort of like turning point in your career or in your journey which made you feel like, okay, now this is the turning point, and that is something which you always remember?
Nothing like that. I think on a continuous basis, learning is important. And like for example, in 90s, most of us who made mistakes, we joined together and tried to learn what mistakes we made. In 2008, we learned that macro is a part of investing. Micro alone doesn't work. You have to know macro to know when macro hurts. We got hurt in 2008 by macro, which we didn't even know. So I think I would say the biggest thing is that periodic introspection and thinking that what went right, what went wrong, what you need to do based on the introspection. That is important for you to move forward. Because but for the introspection, I wouldn't have known anything about macro, because till 2007, I didn't know what. If you had asked me what is current account deficit, I wouldn't have known. That is the kind of situation I was in.
And today, if we talk about the macroeconomic factors, and day before yesterday, only India became the fourth largest economy as well, which was announced, overtaking Japan. And now, like Germany is the third one. Soon, we are going to become the third largest economy in the next maybe let's say 3 to 4 years. What do you think are some of the strengths and weaknesses that India has right now in terms of that? Okay, India has this strength, and this is something which is maybe an area of improvement, or we should work on these things.
I think strengths clearly is that I think we created this entire education-based IT services, GCC, technology back office, every moment that we created. I mean, I would have never known when I was studying in IIT in 1980s that India will become such a technology back office for so many companies in the world. I would have never imagined how Bangalore changed. I mean, I grew up in Chennai. I used to go to Bangalore every year. How Bangalore changed. It just dramatically changed. I think that is the biggest positive. Now, I think the tough task, I think now, is how to pull all the people up in India. I think that's the toughest task, I think, that the government has across the country, both state and center, to pull all the people up, because the educated people have been pulled up by this entire movement which happened with the IT services industry and now other industries as well. I think that is a tough task that is ahead at this point of time.
Hmm. And any specific areas of improvement in terms of like unemployment or anything on that front?
I think it's a tough task, you know. See, the point is that people who are educated, let's say from IITs or IIMs and all them, they are like, you know, they're all part of this entire thing. How do you pull the entire thing? They've come up with this apprenticeship model and all that. I think like that, you have to do something to bring everybody up. That is the biggest challenge, I would say. And that is how to bring everybody up. That is the real task ahead, I would say. And I think the beautiful way in which Aadhaar was implemented, the way in which digital stack has been implemented in India in various services, I think that is another thing. Today, India is far ahead of most of the countries in the world.
Hmm. And have you traveled recently outside India to any country, and what did you learn from that country?
Post COVID, I've traveled much lesser.
Hmm.
And I think, I think in areas like digital stack and all, we are much, well, other countries grew much before. So their per capita income is much higher than India. But that is because of what happened long back. So I think India is today one of the fastest growing economies in recent times. But that's where I am.
Hmm. And anything that India can learn from, let's say, China, US, Germany?
The thing is, you know, Germany and US grew long back. China is not a democracy. When you're not a democracy, you can do a lot of things. You can clear entire cities if you want to construct a dam. So these kind of things, you know, you can do in a non-democracy much more easily. In a democracy, you can't do it. In democracy, you have to follow processes. So that means there are certain things that China will be able to do. Once you're a non-democracy, you have certain things that they have advantages in, and that is there are big advantages of a democracy. That is the thing.
Got it. Super insightful conversation. I think very, very interesting point of views on a lot of things. Last question, which I ask all my guests. So it's a tricky one again. If you were in the shoes of Kushal Lodha and if you were interviewing Mr. S. Naren, what is one question you'd like to ask him towards the end?
I don't know. I think, I've spent my entire career in investing.
Hmm.
So I would say that many people don't. I would say that in many parts of India, I would say in Bombay uh, and Gujarat, people take investing very seriously. In many other parts of India, people don't take investing seriously. I think investing is a very important part of life, and they don't take it as seriously as, for example, I grew up in South. In South, they take education very, very seriously, and it has helped South India significantly. But they don't take investing very seriously. I think West India takes investing much more seriously than South India. I think South India has to take investing much more seriously. And just like they took education very, very seriously, they should take investing also very, very seriously. So they should think, how are they going to invest for their lifetime? Just like education, investing is also an important thing. Taking care of health is important. Taking care of education is important. Taking care of family is important. Taking care of investing is important. So I would say all are important, and that I think people miss.
Hmm. So why do you think like in people in South they are not prioritizing investing? What's going wrong there?
I don't know whether prioritizing. I think they have historically prioritized education.
Okay.
I do not know why, but I think education is prioritized over everything else in South.
Hmm. Yeah, which is why the reason for higher literacy rates also
Eh,
versus any other city.
Yeah, yeah.
Right. Oh, that's insightful. Thank you so much for doing this. It was very interesting to talk to you, and I'm sure audience is going to love this conversation. Any last message for everyone?
The other thing is that, see, I've had a special child, and I can tell you that has been one of the things that I would say my family has supported me in this entire thing. My wife has supported me totally in this entire endeavor of being an investment manager. Otherwise, I couldn't have done it.
Hmm.
And to manage a special child has been a very, very tough part. which my wife has taken full care of, which is why I could do this job.
Wow, that's very touching.
Yeah.
It must be quite difficult, I mean, for
Yeah.
you and also.
Much more for my wife than me because I did this job.
No, but I mean, that's very, very touching. And thank you so much once again for doing this. I am absolutely like in awe of your entire story, very inspired by your journey as well. And the way you are very candid, very frank, and the humility that is being shown in the entire conversation. Whenever I asked about best, worst investment, you'll talk about worst first and then the best. It shows how humble you are as a person. Thank
No,
you so
no,
much for
not
doing
at-
this.
Not at all.
Thank you so much. Once
Thank
again.
you.
अगर आपको ये वीडियो पसंद आया होगा तो आई रिक्वेस्ट यू टू शेयर इट विद ऑल योर फ्रेंड्स एंड सब्सक्राइब टू आवर चैनल सो दैट वी कैन गिव यू मोर वैल्यू एडिटिव कंटेंट इन द शॉर्टेस्ट अमाउंट ऑफ टाइम. हमको ये बताइए कि आपको कौन से काइंड ऑफ गेस्ट चाहिए, हमको ये बताइए कि कौन से क्वेश्चंस मुझे नहीं पूछने चाहिए थे, कौन से क्वेश्चंस मुझे और पूछने चाहिए थे ताकि आपको और ज़्यादा वैल्यू मिल सके, और कौन से ऐसे पार्ट्स हैं जो आपको बिल्कुल पसंद नहीं आए ताकि हम लोग ये पार्ट स्ट्रीम कर सके फ्यूचर एपिसोड्स में. सो थैंक यू सो मच वंस अगेन फॉर वॉचिंग दिस एपिसोड एंड कीप शेयरिंग ऑल आवर एपिसोड्स विद योर फ्रेंड्स एंड कीप गिविंग अस फीडबैक so that we can improve and come up with better quality content.